So next topic is implied adjustment. Implied adjustment is nothing but a hidden adjustment. In receipts and payment account, some additional information is given regarding certain items. On the basis of such information, some accounting adjustments are necessary. So such adjustments are known as implied or hidden adjustments. These are the some hidden adjustments will be there. So we in a final accounts we calculated a bonded and insurance and advertisement. There were hidden adjustments for the rent, like that only in the receipts and payments also about payment account we have some hidden adjustments. Using those hidden adjustments we will calculate a receipts and payments account. So this is some implied hidden adjustments are given below. Some what are the hidden adjustments are coming, that has mentioned here. So first one is rent. So for 11 months is rupees 11,000 rupees, and 10% loan from Bank of India rupees 20,000 taken on 1st Jan 2020, and leasehold land rupees 1 lakh for 10 year from 1 1st April 2019, and sale proceeds furniture book value rupees 7,500 and rupees 8,000 rupees. So these are the hidden adjustments are given. For example, specimen of receipts and payment account for the year ended 31st March 2020. Receipts and amount payment. So by 10% fixed deposit deposited on 1st Jan 2020, that is 1 lakh in a credit side. So and in the above example, implied adjustment is outstanding interest on fixed deposit, because this is a on the fixed deposit there is a interest, 10% interest. So no receipts of interest on fixed deposit is given, and interest is calculating outstanding deposit, because first one is no receipts of interest on fixed deposit is given, no receipts on the fixed deposit is given. So and rate of interest on fixed deposit given along with the date of deposit with bank, that is your date also is given 1 lakh 1st Jan 2020, and therefore it becomes a necessary to take account the outstanding interest on fixed deposit. So therefore it becomes a necessary to take into account that the outstanding interest on fixed deposit for 3 months, that is first Jan 2020 to 31st March, first 31st March 2020. So it is a 3 months gap first. So it becomes a 10% on 1 lakh, means it is 10% per annum rupees 2,500 rupees adjustment in final accounts. So like this we are taking the fixed deposits for 3 months, 10% per annum rupees 2,500. Then outstanding interest and a fixed deposit rupees 2,500 should be credited to income and expenditure account. It is shown on the asset side of the balance sheet, and fixed deposit are show separately on the asset side. This is the one hidden adjustment they are given, and we'll see later on while calculating on the problems. We'll first finish with the theory part. So next is capital fund. Capital fund is shown on the liability side of balance sheet. Capital fund will be shown on the liability side of the balance sheet of not for profit concern. Capital fund is created from capital incomes and by capitalizing surplus, if any. The net surplus is added in the capital fund and deficit is deducted from a capital fund. From the capital fund, net surplus is going to add, and in the capital fund deficit fund deficit is deducted from capital fund. These are the adjustments. Now this is the specimen of balance sheet. So capital fund, liability side and asset side. Capital fund opening balance, add donations, capitalize and entrance fees surplus. Surplus we are adding, and deficit we are taking, we are going to deduct. So building fund, endowment fund, tournament fund, special fund, charity fund, and sundry creditors, bank overdraft, other loan, outstanding expenses, pre-received income, subscription received in advance, life membership fees. These are the liability side it's coming. And in the asset side, what are the entries are coming? Cash in hand, cash at bank, fixed deposit investment, sundry debtors, land and buildings, furniture and fixture, plant and machinery equipments, playground, motor vehicles, library books, stock of sports material, stock of sports material, stock of stationery, stock of drugs, loans and advances given, accrued interest and prepaid expenses and outstanding expenses. So in a P&L account also we are calculating a balance sheet and the balance sheet, trading account, final accounts, P&L account, profit and loss account. So same like that only we are going to collect the method is same, but the thing is we are calling the name is receipts and payment, and income and expenditure name we are giving. Only that is the difference, but the method is same. When we are calculating in a final accounts, the method is we are using the same method, and some entries are going to change, surplus and deficit and a capital fund. These are the things that little bit adjustments are there. So this is a balance sheet, specimen of balance sheet. Next one is, so sometimes instead of adding surplus is with capital fund we are adding a surplus, and deficit we are deducting in the capital fund. But sometimes it is accumulated as a credit balance to income and expenditure account. So sometimes it is a amount is accumulated with a credit balance to income and expenditure account. Such balance is shown separate in balance sheet on the liability side, making their of maybe as under. So income the expenditure account, and opening credit balance and surplus of current year. This adjustment will come for the adding surplus account in a capital fund that sometimes accumulated as a credit balance in income and expenditure account. Additional information of outstanding expenses in the final accounts. Outstanding expenses it has given in the adjustments, though that we are adding with a particular expenses of the outstanding expenses in the final accounts. So in outstanding expenses are the expenses which are unpaid. Two effects: first one is add outstanding amount in the concerned expenditure and expenditure side of income and expenditure account, and show outstanding expenses on liability side of balance sheet. So outstanding expenses we are always adding with the particular expenses. This is the outstanding expenses. So prepaid expenses are the expenses which are paid in advance. These are the So next one is prepaid expenses. Prepaid expenses are the expenses which are paid in advance. So two effects of calculation are there in a calculate in a prepaid expenses. First, deduct the prepaid amount from the concerned expenses on expenditure side of income and expenditure account. Show prepaid expenses on the asset side of balance sheet. So prepaid, whatever the amount paid in advance, that amount will go in a balance sheet, and the deduct in a P&L account. Means in this we are taking in the income and expenditure account, we are deducting the prepaid amount. So this is the adjustment of two effects of adjustment of prepaid expenses. Next one is accrued income or outstanding income. In the income which is earned during the year, but it has not been received during the year, it is an outstanding income. So it is earned in this during the current year, but has not been received during the year. So this year only not get the amount received. So that is the outstanding income. So two effects of calculation are there for accrued income. That is our outstanding income. So in a outstanding income is added in the concerned income on income side of a income and expenditure account. In a income side, the outstanding income is added in the concerned income in a income and expenditure account. And outstanding income is shown on the asset side of the balance sheet. So these are the two effects. These are the two adjustments are coming for the accrued income or in outstanding income. In a outstanding income income and expenditure account, this will be concerned as a added to the concerned income. And in a balance sheet, the outstanding income is shown on the asset side of the balance sheet. Now, income received in advance or pre-received income. So, income received in advance. Sometimes income is received during the year which is actually related to the next year. So, received in advance, the next year amount is received in advance. It is income received but not earned. So there are two effects for the income received in advance. First effect is the amount of income received in advance is deducted from the concerned income in income and income side it will come and in a income and expenditure account. This amount will be deducted in a income and income and expenditure account. So income and received in advance that amount will deduct from concerned income and in that and second effect is show on a liability side of balance sheet. So this is the two effects of adjustments in income received in advance or pre-received income. And next one is subscription received in advance and outstanding subscription. Subscription is a revenue income of not for profit concern. Subscription may be given periodically. All members have to pay subscription regularly. It is credited to income and expenditure accounts. So this amount, the subscription received amount will come in credit side of the income and expenditure account. So subscription can be classified as a subscription of current year received in the current year and subscription of previous year received in the current year and subscription of next year received in the current year and subscription of current year is outstanding. So these are the four methods are coming in a subscription received. Current year, previous year, and next year and current year is outstanding. And depreciation. So depreciation we used to deduct some percentage amount of with some furniture, vehicles, machinery in a balance sheet. So that the depreciation amount we used to take in a just we used to take a depreciation percentage amount we used to take in a P&L account. In a balance sheet we used to deduct in a particular amount with depreciation. So depreciation also two effects debit side of an income and expenditure account. So think that this is a P&L account, profit and loss account you are calculating. The method is same but the name is different. This is an income and expenditure account, but it you used to calculate the debit side of the P&L account also. Depreciation we used to take a depreciation percentage amount used to take in P&L account and deduct from the concerned asset from balance sheet. So suppose furniture amount is 10,000 rupees. So deduction of the 10% is a deduction from the furniture will give an adjustment that we are deducting with the concerned asset means furniture we used to deduct the amount and taking in the balance sheet. These are the two effects of depreciation. Next is capitalization of entrance fees. Entrance fees are the fees paid by the persons who intend to become a member of the organization. So who are interested to join the membership organization, there is a entrance fees or fees to be paid by the person. Generally, entrance fees are treated as a capital receipts. So who are paying the entrance fees that will be treated as a capital receipts in income. But sometimes part and it can be treated as revenue receipts. Entrance fees received rupees 50,000, and additional information 50% entrance fee should be capitalized, and 50% of rupees 50,000 is 25,000. So the entrance fees is a 50,000 rupees. So 50% of rupees 50 is 25,000 rupees. Rupees 25,000 will be added in a capital fund, and rupees 25,000 will be treated as a revenue income, which is credited on income side and income and expenditure account, deduct from entrance fees. So this is the capitalization of entrance fees. How we are treating the capitalization of entrance fees. Entrance fees, how we are taking in the income and expenditure account. This method we are making it a half. So next one is creation of special funds out of donations. So donation means gift given by either members or any outsiders to the organization. Types of donations. So someone is given gift to by either members or any outsiders to the organization. This donation is divided into two parts, that is general donations and specific donations. So general donations treat as a revenue income and will be shown in the income side of income and expenditure account. So general donations, it is showing in the income side, that is in the income and expenditure account. These donations are given without any condition. And specific donations are sometimes given for specific purpose. The donor specifies the purpose for utilizing the amount donated by him. So the donor who is paying the amount, who is donating the amount, he will specify the for what purpose. So donate the donations for building fund. Suppose example, donations for building funds. They have the donator they have mentioned the specifies purpose, means if he's giving it for the building fund, donation for building fund, and donation for prize fund, and donation for sports and tournaments, etc. So such donation should be shown in the liability side of balance sheet. These specific donations, whichever the amount are coming, specific donations like a building fund and donations for prize fund, donations for sports and tournaments, these entries are coming in a liability side of a balance sheet. And general donations, that is coming in donation income and expenditure account of income side. And how we are treating the stock of stationery. Stationery is an expenditure. It is consumable item. It may be calculated as an opening stock of stationery, some amount, and add purchase of stationery during the year, and add outstanding stationery bill, and less closing stock of stationery. So how we used to calculate a bad debts and bad debts and old add new bad dates and plus RDD, like that we are adding these things like add purchase of stationery in a opening stock, and the stationery amounts are coming in a opening stock of stationery. So less closing stock of stationery, so total amount is called as stationery consumed. So stationery consumed is to be debited to income and expenditure account, and closing stock and stationery will be shown on asset side of balance sheets. So closing stock, and in a trading account we used to treat a closing stock, and again in a balance sheet also we used to take in a closing in balance sheet also we used to take a closing stock. So like that, here we are taking in a income and expenditure account and in a balance sheet asset side. So next is same treatment as I did beyond for sports material consumed in medicines, drugs. For this also, this method is apply. And opening balance of assets and liabilities, and opening balance sheet. At the beginning of accounting year, the accounts of assets and liabilities show balance. With these opening balances, opening balance sheet is prepared. So while preparing final accounts of the concern, these balances are property taken into account. So capital fund should be represented on liability side of balance sheet. Refer 2 is to 3 is to so for the partners distributing, we used to use the ratios 2 is to 3 is to 2 ratio, 2 is to 3 ratio, like that. So in a capital fund, we are referring a 2 is to 3 is to 8 ratio. So whatever they mention in the problem, we'll take these ratios in the opening balance of assets and liabilities of opening balance sheet. Next one is important terms, entrance fees. Important terms, the first one is entrance fees. In a please Okay, subscription, entrance fee, subscription, legacy. Legacy means gifts received under the will on the death of a donor. This gift may be for general or special purpose. So, general gift revenue income, which is credited to on income side of a income and expenditure account. Special purpose gift, it is a capital receipt, so it should be shown on the liability side of a balance sheet. And life membership fees, in not for profit concerns, same members pay life membership fees. It is non recurring income, therefore, it will be shown on a liability side of a balance sheet. Since it is a non recurring income, that's why it is showing in the liability side of a balance sheet. And next is a sale of old assets. When any asset become obsolete or useless for the concern, it is sold out. Amount realized on it in a capital receipt, the book value of sale of such asset is deducted from the concerned asset. So the difference between the book value and released value is either profit or loss on sale of asset. If there is a profit, it should be shown to income and income expenditure account. If there is a loss, it should be shown on the expenditure side. If it is a profit, it will be shown in the income side, that is in income and expenditure account. If it is loss, that will show in the expenditure side of income and expenditure account. So how we used to mention in a profit and loss account, if it is a net loss and a net profit, how we used to pass the entries like that. If it is a profit, that will come in the income side. If it is a loss, that is the expenditure for the organization. And sale of scrap newspapers, etc., scrap old materials is sold in the market. It is treated as a recurring income, therefore it is credited in income side of it. So we are getting some amount, the scrap, these amounts, sale of scrap newspapers and scrap, these are the sold in the market. So it is a income, recurring income for the organization, so it is credited in a income side of, there is a income for the organization. So we are mentioning, we are passing the entry in a income side of income and expenditure account. Sale of old newspaper is a miscellaneous income. It is credited on income side of income and expenditure account. Next one is endowment fund. It is a fund created out of specific amount, embark, gift or donated. The income of this fund is specific income. It's shown on the liability side of the balance sheet. Endowment fund. So it is created out of specific amount, embarked, gift or donation. Donated, gifted or donated, this amount, this entry, endowment fund entry, will and come show on the liability side of the balance sheet. So this is a till here, this is theory part of not for profit concern. In the next class we'll solve the problems on not for profit concerns. Thank you.